Hi, guys, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno Larsen, sending to you live Monday, September 19th, ahead of a big central bank week. And that's why we're going to ask the question today whether the Fed will be able to stick to their guns on Wednesday when we get the conclusion at the FOMC meeting. And with me to discuss this week of central bank action, I've invited maybe the best central bank watcher I know out there, namely Darius Dale, the CEO of 42 Macro. Darius, really good to see you again.
I take great offense to that.
My apologies.
I don't know if I want to be known as the best central bank watcher, but I appreciate you, brother.
Let's call you the best inflation watcher then. But before we get to the discussion on the Federal Reserve, I wanted to debate the backdrop macro-wise heading into this meeting on Wednesday. Of course, inflation is of great importance for the Federal Reserve reaction function. So why don't you give us the overview of the current inflation pressures in the US heading into this meeting?
Yeah, absolutely. So I'll start taking a step back because you mentioned it's a big week for global central banks. I think we have somewhere on tap like 500 basis points of rate hikes programmed for this week, at least according to what markets are predicting across all the different central banks. Let's isolate the Fed here because, again, I think the Fed's decision tree is becoming increasingly clear, at least with respect to the August CPI report. So a couple charts on that, just kind of getting us started here. Claire, if you put up slide 73 that we sent you where we show the core inflation pressures in the U.S. economy on a 3-month annualized rate of change basis. And you can see just going across the chart, looking at the different clusters of bars, you have core CPI at 6.4%, 3-month annualized. Again, we're not looking at year over year because, again, the year over year statistics are noisy. There's a lot of non-information in the year over year. But I think what the Fed and other investors like myself are looking for is to see if the trending momentum in the time series, the sequential momentum, can actually get to a level that's at or near 2%, well before the year-over-year time series to get there. So just looking at a 3-month annualized rate of change basis, you have core CPI at 6.4%, you have core goods CPI at 5.9%, and these are August numbers. Core services CPI at 6.5%, shelter CPI new high at 7.4%, and then lastly, services CPI less rent of shelter at 7.4%. These numbers are ridiculous. I mean, we all know the year-over-year numbers are high, but when you're talking about 3-month annualized rates of change in the month of August, we're still building a considerable amount of inflationary pressure in the system. And this is why, if you look at slide 92, Claire, which I think are some of the most important time series to look at when you're talking about contextualizing inflation momentum in the U.S. economy, whether it be trim mean CPI, which popped up to 7.7% on a month-over-month annualized basis in August, median CPI, which popped up to 8.9% on a month-over-month annualized basis in August, which is a new all-time high, and then sticky CPI, which popped up to 7.7%. These numbers are all well north of the pre-COVID trends, which are the light blue bars in each of those charts. So I think the key takeaway here is there a possibility for a hawkish surprise relative to what is already expected to be quite a hawkish meeting when you look at a 75 basis point rate hike being priced in, and obviously a positive revision to the dot plot that's going to be more in line with market pricing.
We have a little bit more than 75 basis points priced in for this meeting on Wednesday. But if you were Jay Powell and you wanted to communicate this tighter for longer narrative, what would you say on Wednesday to sort of emphasize that?
Yeah, so I think it's less about what he says and more about what the Fed does. So obviously they can shock and awe if they opt for 100 basis points. I don't think that's neither here nor there from my perspective, because I think what the Fed doesn't want to do, as Jay Powell eloquently succinctly put it, going back to Jackson Hole, which is they don't want to do an about face and do a reverse pivot, a dovish pivot, because again, their data, all of our data shows that part of the reason we had such an elongated inflation episode in the 70s is because we had these intermittent periods of tightening and easing. And what the Fed doesn't want to do is be forced into easing because it overdid it in terms of the monetary tightening. So I think 100 basis points is probably less of an issue in terms of markets having to react to that. What I think is more of an issue is the Fed taking its dot plot, the terminal Fed funds rate expectation amongst its committee members. And again, this is not like a Fed deciding this. This is individual committee members voting and putting their own median forecast, median estimate in there. And if that dot plot gets to a level that is A, in line with market pricing, and B, if you look at the longer run projections of neutral and the longer run projections for the dot plot, i.e. where are we going to be in 2024, et cetera, if those numbers are still sticky and elevated. To me, I think that represents very tacit admission of the Fed acknowledging that we are in this sort of phase 5 of the global liquidity cycle downturn, which we talked about last week, which is acceptance. Let's just accept the fact that we're going to get rates really high and we're going to keep them there for a long period of time, which I would argue and our data would show is that outcome is not adequately priced in and across financial markets.
Darius, as investors, we tend to miss the forest for the trees if we're stuck in a debate on whether it will be a 75 basis points or a 100 basis point hike on Wednesday. It doesn't really matter for sort of the medium term trajectory for the Federal Reserve, right? So in terms of the medium term signals and the consequences for asset allocation, what will you be watching on Wednesday in relation to that?
Yeah, no, look, it's about the Fed, Jay Powell using his words and the Fed officials using their dot plot votes to effectively tell us that, look, we're not cutting rates next year. Get it out of here. We might not even cut rates in 2024. I mean, if you look at slide 79, Claire, what I sent you, I just show the euro dollar calendar spreads for 2023 and 2024. And we're still somewhere around minus 32 basis points for 2023. Minus 66 basis points for 2024. So right now the markets are pricing in effectively from the terminal Fed funds rate. We're going to cut rates right around 100 basis points from basically starting in second half or first half of 2023 through the end of 2024. I think that has to be in my opinion that has to be a median expectation, because the reality is if the Fed does wind up cutting rates, they're going to cut rates a whole hell of a lot more than 100 basis points, right? This is a Fed that panics especially this Jay Powell Fed. This is a Fed that is predetermined to panic when it comes to the economy, if they just deem that the economic growth outlook and the unemployment outlook, and that becomes more important than currently their war on inflation. But so that tells me that, hey, look, what if we don't get that sort of really deleterious economic outcome? Then it's probably that's 100 basis points of tightening that is very unlikely to happen. I think there's a lot of investors out there that are sort of anchored on this concept of a recession. And I hear a lot of discussions and debates across Wall Street, institutional investors that's like, well, in a recession, ... or when there's a recession, you got to do X, Y, Z, or ABC. But that's all wrong from my perspective, because right now we still have yet to see an inversion in the yield curve that matters for predicting recessions. We talked about this last week. The 10-year 3-month has not only not inverted, but it's actually nearly doubled in terms of its level since the early part of August. So from my perspective, I don't think a recession is the modal outcome yet. It may become the modal outcome as we continue to see incremental tightening priced in, but for the current, right now, it is not. And as a function of that, there's a real kind of undertone to the bull market in yields, the bear market in bonds, that should continue. And as a function of that, obviously, we're going to continue to see asset prices. So we're going to see that continue to weigh on asset prices.
We got a great question in relation to this exact spread between the 10-year point and the 3-month point on the dollar yield curve earlier today on Twitter. And we got the question specifically on whether we should expect this spread to invert during the fall if the Federal Reserve delivers a 75 basis point hike this week and signals further hikes down the road. What's your take on when this spread will actually invert?
Yeah, no, I think if it's going to invert, it's going to invert probably sometime in November, December. If it's going to invert, because right now, if you look at it on a 3-month forward basis, we're more or less, or we are now including the December Fed funds meeting or December 14th meeting in the 3-month Treasury yield. So that's now inclusive of it. So it's got to we need to see something incremental in this sort of next 3.5 months to cause the thing to invert, either through the lens of investors really starting to increase their duration risk because they're getting incrementally concerned about the economic outlook, or investors getting incrementally concerned about the Fed having to do more from a policy rate standpoint. Again, we all know that this is, at least history has shown, the Fed has had to get policy rates into real territory relative to realized and observed CPI in order for the Fed to, effectively do what it needs to do in terms of slowing demand and slowing the economy. That may not be the case this cycle, but I would argue all indications suggest that that is likely to be the case, just given the information I just shared with respect to core inflation pressures and with respect to trim, mean, median, and sticky inflation pressure.
Even if we can postpone this recession discussion, say another quarter or two from now, it's not necessarily a signal to buy risk assets with an arm and a leg, also given the communication from the Federal Reserve already now. If you look at the developments in the inflation-adjusted interest rate in the US, we've seen a clear pickup in the real interest rate over the past 6-8 weeks. To me, that's usually a signal that we should expect spillovers to other asset classes. Talk to this point of the real rate being sort of the thing to watch in markets right now, Darius.
Yeah, 100%, man. I think, yeah, speaking of spillovers, one thing we track is dispersion within the equity market in terms of trying to monitor changes in flows. We were trying to isolate a sort of shorter term flows between sectors and style factors to kind of front run, or at least at the bare minimum, observe what quote unquote pod shops are doing. These are the big multi-manager hedge funds. They control a decent amount of the market activity on any given trading day, upwards of 75, 80, 90%, pick your day. And so, one thing we see in our dispersion analysis on slide 19, Claire, where we show, just on a month over month Sharpe ratio basis as a proxy for real-time flows, it's been persistently pro-cyclical throughout the summer and into the early part. We're not quite in the fall yet, but we'll be in the fall in a couple of days. That to me has been, it's very inconsistent, at least historically, with the slowing economy. And so what that tells me is that investors are extrapolating their sort of bearish bets on duration in the fixed income market, and they're pushing that into the equity market. If you look at it on a 1-year z-score basis in terms of tracking dispersion from a time series, which is the chart on the right, when you get a positive value or a positive z-score in that chart, it's telling you that the pro-cyclical sectors and style factors are leading the equity market, and a negative value shows you that defensive sectors and style factors are leading and not lagging, more importantly. What we're seeing is a consistent, kind of push to pro-cyclicality. Now, it's not the kind of push to pro-cyclicality that you typically see in a new bull market. We have not observed that level of pro-cyclicality, but it's been consistently pro-cyclical. So to answer your question on spillovers, I think this real rate move has been very clear and very evident. If you think of some of the drivers of the real rate move, namely decline in global liquidity and the strong dollar, it's likely to continue, at least through the fall.
Yeah, I would tend to agree. And I guess the Federal Reserve has been crystal clear on this topic as well. They want to see real rates at positive levels throughout the yield curve, and they want to contain them there for a prolonged period as well, until they see sort of a reaction in the economy and in asset markets. And in relation to that, I wanted to read out aloud the tweet of the day for you. It's a quote from Stephen Blitz, an economist at T.S. Lombard, the great macro shop as well. He said earlier this week that Powell's 8-minute talk at Jackson Hole reminded him of how he learned to speak to his sons when they were teenagers, in short declarative sentences to get his point across. Would you expect Powell to be this explicit again on Wednesday, to really emphasize his point here?
Yes, of course I do, at least in the prepared remarks. But the problem with Powell, we've seen this many times, is that when you get him into these Q&A sessions, like he starts elaborating too much, which is ironic because his background is as a lawyer, and these people tend to be very buttoned up with their words. But in these press conferences, he always winds up shooting himself in the foot. And so I think he's probably going to be really focused on just kind of hammering home the point, which is we're nowhere near done with this tightening cycle. We need to get everyone to understand that, hey, we're not coming to the rescue next year with rate cuts and QE unless something really breaks. And obviously something really breaks has not, in my opinion, at least according to our analysis, has not really occurred yet in financial markets. Obviously, we've seen some pain across asset classes, but nothing's really broken yet, especially if you look at the labor market, which continues to grow at a very rapid pace. I mean, aggregate private sector labor income growth is at 7.6% on a 3-month annualized basis, which compares to a pre-COVID trend of 4.4%. So we're nearly double in terms of how quickly the labor market is growing if you factor in income, total jobs, and hours worked. So I think Powell is going to be very resolute in his commentary, and it just happens to see how kind of how much he does or does not shoot himself in the foot in the Q&A section.
Darius, we hosted Thomas Honig, the former president of the Kansas Fed, earlier this week at Real Vision. And I wanted to play a soundbite for you from his discussion with Harry Milandri in terms of whether the Fed can actually do anything but fail, given the outlook that they have ahead of them, with inflation running way beyond target and the trickiness in terms of bringing this inflation back to target without harming the economy. So let's listen to Thomas and get back to this discussion.
I don't know that the Fed is being set up for failure, but it is being set up for a huge challenge. Because if the Federal Reserve acts independently, it refuses to compromise on buying all the new debt, that means interest rates have to go up even more because someone has to pay for it. And to get them to do it, get the private sector to do it, you have to pay more interest because they're competing for those available funds. And so if the Federal Reserve says, yes, fiscal authority, you're spending, but that's your decision. We are not going to have inflation back up to 5 and 6 and 8, 9, 10%. And so you have to make some decisions yourself. That will bring animus towards the Federal Reserve, as it did Paul Volcker, And that's when I keep saying that's when the test of the FOMC will really take place. Right now they can do it because unemployment's low. And wages, even though they're falling behind, at least they're increasing to some degree. And people want inflation brought back down. But if the unemployment rate starts to rise significantly, and if the economy does slow into a recession, even if inflation is still above 6 or 7%, there'll be enormous pressure on the Federal Reserve to reverse itself. And that's when we'll know whether they're going to stick to the plan.
The entire interview with the former head of the Kansas Fed is already available at the Real Vision platform for subscribers today. But back to you, Darius. I have to admit that I'm personally almost grateful that I'm not on the committee voting this year, because it is a tricky task to get inflation back to, say, 2 to 2.5% without harming the economy. Do you think the Fed is stuck between a rock and a hard place in this debate?
No. I mean, I think I think it's only a tricky task if you don't want to harm the economy, but we know how to get rid of inflation. History it's been long documented that if you sort of ameliorate some of these supply demand imbalances, i.e. by whacking demand, you can get inflation under control. The alternative obviously is increasing supply, but we know how difficult and challenging that's going to be in terms of getting expeditious responses in inflation. It could take, if we go the supply route, it could take us 3, 4, 5 years before we see any really meaningful developments on the inflation front. So I'm not sure how many people really want to stomach, 8, 9, 7 to 9% inflation for 3, 4, 5 years. I think by the end of that process, a lot of the people on Twitter who keep screaming it's only supply will be kind of quite sick of that, but that's neither here nor there. One thing I would bring up with respect to Dr. Honig's discussion in terms of, the Fed, kind of being destined to, not quite destined to fail, but seem to be on this path that may make it destined to fail. You and I have talked about this throughout the year about our secular inflation model here at 42 Macro. It's about 16 different variables, spanning different things like deglobalization, the changes in the composition of labor force, changes, jump conditions in wages, et cetera, things of that nature. And then what that model is suggesting is that, the stationary meaning, the trend, the underlying trend of core PCE, which is the Fed's preferred inflation metric, obviously, has increased by, on the high end of that estimate range, somewhere around 120 basis points from the previous decade. And that model does not include things like commodity prices or the dollar, because those variables tend to be quite hard to forecast and a lot more sort of stochastic. If we get any sort of kind of flow through effect to persistently high commodity prices, you're talking about core PCE on an underlying trend basis in this decade, somewhere north of 3%. I pause for dramatic effect, because that means if it's sticky and somewhere north of 3%, means the Fed's going to have a hell of a time in terms of the damage it's going to have to do to the economy to get it to go from 3 to 2. And so it's been my hypothesis really for, the last, 6, 7 months, is that by the end of this tightening process and the end of this sort of economic downturn, and we're talking about trying to go from 3 to 2, I think that's when we're likely to see a positive revision to the Fed's inflation forecast. I mean, hell, we already saw one in August of 2020 when they abandoned 2% for, in exchange for the average inflation target. I think the next step in that process is just openly and tacitly and explicitly admitting that, hey, look, the number's now 2.5 or 3, as opposed to trying to get it to 2. I don't think they need to do that yet, because the trade-off between unemployment and inflation is not really much of a trade-off at this particular juncture. But when we get to, let's say unemployment in the 4s or 5s, that's when I think they're going to have a much more difficult time politically in pursuing a path of that gets inflation from, let's say, 3 to 2, as opposed to going from 9 to 3.
If we assume that you're right, that they will accept a higher sort of median trajectory for the PCE index over time, what will that mean for the long-term projections for real interest rates? We agreed that real interest rates matter a lot for asset pricing across assets, but what will that mean for the real interest rates over time?
Yeah, it probably implies lower real interest rates. If you think about just kind of mechanically, if you have persistently higher inflation, you're probably going to have lower real interest rates. But you can also make the case that it probably augurs for higher real interest rates. Because again, the other side of this is that we're probably having an economy that has higher nominal growth, on a consistent basis relative to the prior trends. And so I could easily see a situation where, the bond market just, repudiates the concept of changing the Fed's inflation target, and all that 40 and everybody's 60-40 portfolios starts looking for new homes, and eventually by the end of the decade it's probably somewhere around 30. I think this, if we have a positive revision to the inflation targets for not even the Fed, but it could be global central banks as well, we are going to see 60-40 go to 60-30-10. There's no question about that, because there's just too many bonds in the system and not enough buyers in the context of a structurally higher inflation regime that central banks are acquiescing to. Remember, we talked about this. If the central banks want to get rid of inflation by destroying the economy, that's bond bullish. If they allow inflation to fester, or at least have a structural change higher, jump condition higher, that's bond bearish long term. And I'm not sure what the appropriate price of bonds is, but I do know it's not 3.5 on the 10-year, because again, we got term premium at minus 50, 60 basis points right now. That could easily go to plus 50, 60, or if not 400 like it did in the 70s. I don't think it's going there, but it certainly has that range.
If we look at the most recent development in central bank balance sheets in relation to bond markets, one of the questions that I've been asking myself over the course of the past couple of months here is whether this balance sheet reduction is positive or negative for bonds. We've seen earlier that bond yields have actually dropped in times of tapering, quite in contrast to what you should expect from a supply-demand perspective. But what do you make of that debate of the central bank balance sheet sizes and the bond market?
Yeah, so a couple things. Claire, if we thought this chart, this is the 26, where we show the G5 central bank balance sheet in dollar terms, that number has declined about $4 trillion from its February peak. And as a function of that decline, inclusive of all the changes that we've seen in all the rest of the central bank balance sheets, we've seen a $26 trillion decline in the world equity market capitalization. That's the red line in the chart. The blue line is the G5 central bank balance sheet, and the black line in the chart just shows the Bloomberg Global Aggregate Index, which is an index of investment grade bonds. It's not the total stock of capitalization, but it's a particular index, and that index is down 11 trillion since peaking. And as you notice, both of those indices, the red line and the black line in this chart, peaked in advance of the decline in the central bank balance sheet. So markets were in fact front running the decline. And so, going back to, kind of your discussion, if we're going to continue to see this decline in central bank balance sheets, particularly on dollar terms, because to me, I think that's one of the most important aspects of this whole decline. Actually, if you throw up a chart, slide 27, where we show the ECB's, Bank of England, Bank of Japan, and PBOC's balance sheet in dollar terms, they're all declining. And the reason I have my hypothesis on this is just that we can't support the outstanding stock of dollar assets in the world when these central bank balance sheets are declining in dollar terms, because again, it's evaporating the liabilities on the other side of those balance sheets in terms of the currency and the ability for these asset markets to, to create credit, create liquidity for investments. And so, in my opinion, as long as we're going to be in this environment in terms of declining central bank balance sheets in dollar terms, it's going to have a positive influence over global bond yields. We could start to see a negative influence on global bond yields once the dollar starts to peak out and roll over. But in my opinion, I don't think a dollar peak is going to really come to fruition unless we really start to see some significantly negative economic performance in the U.S. There's two types of tapering. There's tapering when everything's fine economically and bond yields tend to rise, at least according to our grid asset market backtest. And then there's tapering when the economy is slowing and slowing significantly and bond yields tend to fall. I don't think we're at that point in the latter part of the process yet. We're slowing economically, but we're not necessarily slowing either to a point or at a fast enough pace that has investors freaked out about the growth outlook, again, as evidenced by the lack of inversion in the 10-year 3-month yield curve.
If we look at the current positioning in CFTC futures, both in equity space and in bond space, it is pretty clear that investors are short both assets, so both bonds and equities at the same time. And we've basically been used to a decade of performance in bonds when equities sold off and vice versa. So what do you make of this rotation towards equities and bonds selling off at the same time and maybe gaining at the same time again here, Darius?
Yeah, so we've shown this in our work as well, 42 Macro. I mean, when you have inflation crossed this sort of, it's somewhere between 4 and 5% empirically, and this is data going back to the 1800s. When you have inflation cross that threshold, the covariance between stocks and bonds flips to positive. And the higher the level of inflation, the higher the level of covariance. And so, there's a lot of things that happen when you have high levels of inflation. Sort of things like economic volatility, both nominal economic growth, real economic growth. Those things scale linearly with the amount of inflation volatility you have, which obviously, if you have higher inflation levels of inflation, you tend to have higher inflation volatility. So there's a lot of stuff that tends to happen on the negative side when inflation is really high. Now, again, we're going to get back, in my opinion, at some point over the next 12 to 18 months to 3% inflation. Hell, we could be there by 6-9 months from now if you look at it on a 3-month annualized rate of change basis. Which I think, again, the market is more focused on the sequential because we know the sequential is going to beat the year-over-year numbers by several quarters, if not quite a few months, or sorry, several months, if not a couple of quarters. So when we get to those levels, where will we see that inverse covariance? I would argue we will probably start to see it because, again, by that time, by let's call it 2-3 quarters from now, the economy will be in a worse off state. The labor market will be in a worse off state, and the market can really start to anticipate a Fed pause or something that maybe look like an implicit pivot or something. I don't know. Maybe they change the SLR or something like that in terms of kind of trying to provide relief to the fixed income markets.
We have time for a couple of questions from the audience, Darius, and we should remember that there are other central bank meetings this week than the Federal Reserve. We have a meeting in Bank of Japan, we have a meeting in Bank of England, Norway, Sweden, etc. A load of them this week. And we've got a question from another Andreas, actually, so maybe I have a fellow Scandinavian watching out there. He's asking you, Darius, since the Fed decision is sort of a relative game versus other central banks, what do you see the other central banks doing this week if the Fed hikes by 75 or even 100 basis points?
Yeah, I mean, they're all playing catch up, right? I mean, you pull up a chart of the dollar, it just tells you what's happening, which is the Fed is keeping pace with the change in tightening expectations amongst all these central banks. Now, when it starts to not keep pace is when you're going to start to see the dollar put in at pretty meaningful secular high, and perhaps that could be a secular high that lasts for several years. But for now, the Fed is still quite resolute because, again, I think the labor market and the inflation data are telling it to remain resolute. Again, we started this conversation talking about 6 to 7.5% core CPI momentum on a 3-month annualized basis, 8 to 9%, trim mean, median, sticky CPI momentum on a month-over-month annualized basis. We are nowhere near levels of inflation sequentially or labor market growth sequentially that will allow the Fed to pivot. So going back to this question on the dollar and what other central banks are going to do, we think they're going to try to keep pace. Heck, you might even start to see other central banks, probably not the ECB, but maybe Bank of England or something, change the speed with which they're tightening so they can try to gain some ground against the Fed. But ultimately, we don't really see material ground being gained until we get, probably into the early part of next year.
We have a tremendous question from a viewer called Michael, and it's a fairly technical question, so I'm trying to translate this into sort of layman words. But he's asking you about the issue of the Federal Reserve having bought a lot of bonds on the balance sheet at lower interest rates compared to the yield levels that we see right now in markets. Through 2019 and 2020, the Fed obviously remunerated deposits with 0 interest rates to counterparts. But now that they've raised interest rates, they are starting to pay interest to the counterparts with excess liquidity parked at the Federal Reserve at maybe even higher levels than the interest rates they bought implied in the bonds that they bought throughout the pandemic. What do you make of that discussion? Is it something that is important for the Fed reaction function now that the yield environment has sort of shifted to an upwards direction?
Yeah, I mean, that sounds like, so it's important if the Fed was a private sector entity. I mean, think about if the Fed were an actual bank, they're basically borrowing at a higher level of interest and paying they're paying a lower level of interest in their, it's the other way around. They're paying a higher level of interest than they're funding. So that's an issue. But this is an entity that prints, I don't want to say money because I'm going to make people explode. Their heads are going to explode. But this is an entity that prints the things that it needs to pay people with. How about that? Whatever you want to call it, because I'm not going to get in that philosophical discussion today because I don't have time for it. But yeah, no, the Fed is fine. This is not an issue. The issue is that the Fed's balance sheet is contracting. And because investors don't want to take equity or sorry, not equity. They don't want to take credit risk, duration risk, or liquidity risk. They're parking $2.2 trillion of excess liquidity with the Fed. They don't have to do that. If we got some sort of signal that, hey, look, we need to go buy a bunch of bonds or buy a bunch of stocks, I guarantee you that excess liquidity in the reverse repo facility will go from 2 trillion to 1 trillion to zero. Could go to zero, but it doesn't need to go to zero, and it doesn't appear to like it's going to be declining in any substantial degree over the medium term, because again, the economic signals remain quite poor. The monetary tightening signals remain quite poor, and I still think, going back to that Eurodollar calendar spread chart, there is still some way to go in terms of the Fed convincing market participants that we're not returning to the previous, kind of easing cycle on any risk manageable investment horizon.
And that leads me to the final question from the audience today. It's actually from my colleague Ash, but I wanted to bring it up. He's asking you, Darius, what does it take for the Fed to reverse course and cut? What would they need to see breaking in the economy, and how much pain would they need to see before they actually decide on a reversal?
Yeah, it's going to be through the lens of the labor market, right? I mean, could they cut if we got into a really adverse situation from a financial stability standpoint? Yeah, of course. I just think that's a lower probability event. If you look at, again, we talked about this last week. There's like there's $7 trillion of excess liquidity sitting on consumer and corporate balance sheets. About 4.9 trillion for U.S. households. There's about 2.1 trillion for U.S. corporations. Everybody is itching to buy the dip. No one really wants to buy the dip until they get some signal from policymakers that it's safe to buy the dip. And we just don't think we're going to get any of those signals again anytime soon. I mean, we'll probably get some signals. Let's call it sometime in early next year. But again, it's September 19th. We got a lot of risk to manage in between now and then.
Yeah, we certainly have, Darius. So I'll try to sum up on today's discussion, and I'll like to introduce the meme of the day in relation to that summary, because I think you're very clear in what you say today, Darius. The Fed will continue to signal that we are in a tighter for longer monetary policy regime right now. Whether it's tight enough will be sort of dependent on the labor market and risk assets. But I mean, given the amount of cash parked on the sidelines still, it's not necessarily a scenario that will lead equities to new lows compared to the ones we saw just before summer, even if we have this outlook of weaker economic growth and tighter financial and monetary policy maybe at the same time right now. Anything I missed there, Darius?
No, I think you summed it up. Again, I think what we've learned since June, of all the things we've learned, is that the economy is more resilient than we thought it was in going back to June. I think there was a real debate and discussion around a recession commencing, kind of sometime in Q4, even as early as Q1. I think if a recession does commence, it could be probably a Q3, second half of 2023 event. And so that additional, that additional space of time allows for the continued growth of earnings, continued growth of corporate profits, consumer income, et cetera. So, this economy has a little bit more juice, at least the U.S. economy, than we initially thought it did. And because of that, going back to your point, do we need to retest the lows? Do we need to make new lows? I don't know if we need to make new lows, but I do believe a retest of the lows is in order, because again, as long as the Fed continues to hike interest rates, the free yield you're going to get for taking zero risk to park your money with the Fed via reverse entities that have ability to tap that is going to be higher and higher and higher. If we get to 3, 5, or 4%, who in the heck is going to want to buy an equity or credit security when they can just go get that kind of return from the Fed without taking that cycle risk? And so, to me, I think we're headed for some more volatility. It just doesn't necessarily have to be as bad as we thought it was in June.
Word, Darius. It's always a pleasure to cut through the macro noise in your company. So thank you so much for joining the daily briefing again today.
Appreciate you, Andreas, man. Always a pleasure.
I also want to say thank you to the audience out there. It's been a pleasure hosting the daily briefing again today. My colleague Maggie Lake will be back tomorrow with more. Tony Greer will be guesting the show. So see you there.
Bye, friends.